Amit, we are starting the session.
Yeah.
Good morning, everyone. It's 7:30 and time to start the meeting. While our other friends join the session, we'll take the introduction of the speaker. Our today's speaker is CA Amit Dodani. Amit is a transaction advisory professional with deep knowledge in buy-side and sell-side advisory, value negotiation, financial and accounting due diligence, valuations, financial modeling, and other management consulting services. He has assisted clients on matters relating to transactions, be it buying or selling of companies, determining the value of a business, doing due diligence, assisting clients prior to or during due diligence by setting up data rooms, raising private equity finance, and research requirements relating to M&A transactions. He is founder of Equivo Financial Advisors. And our today's topic is to address various practical issues while we follow market approach. Over to you, Amit.
Thank you, Shilpaji, for introduction. Hi, friends. So, the today's topic is the practical approach in the practical issues in the market approach. So, before now jumping into the presentation, I will just start with the basic question. In a today's scenario, we keep hearing, the market is being overvalued, and still as a valuer, we always suggest to use a market approach. So, what do you think? Is it a good idea to using a market approach in this kind of scenario where market always everyone is saying market is overvalued? And I hope I'll just keep this question in the interactive section in question and answer, so it will be easy for everyone to understand the nitty-gritty about the issues on the practical side. So if anyone can just help me with whether we should use a market approach or income approach for the valuation, and if we use a market approach in this kind of scenario where everyone is saying market is being overvalued, so what will be the reason and what will be the issue while valuing a company?
Yes, see, first of all, market approach we will use only when the comparable is available. Because I don't think so. We will see that, okay, whether Sensex or Nifty market is more than, okay, we can apply to whatever valuations we are doing. And then as a valuer, we will see most comparable any transaction or comparable companies. Then if the market overvalued and all, I don't think so. We won't see usually. Maybe now, okay, from your session, maybe we have to see market also.
Actually, I have a point to support Amit's point. Say, for example, when Paytm IPO was happening, at that time, maybe our company, whatever we are valuing, is same to that. At that time, value was so much. Everyone was telling overvalued, but that value was so much. Then we have followed whatever comparables of Paytm and valued our company. After some time, we realized that, okay, Paytm was overvalued. Like a classic example, like instead of generalizing market is overvalued, Paytm was overvalued at that time. So now what? So were we right in doing market approach or not?
So yeah, so that is an interesting topic, whether use a market approach, and if yes, then how we take a comfort using a market approach. So see what we have seen, first, as he mentioned, identifying the peer companies is a bit challenging because, we never see more than 6,000 companies are being listed on the Indian Stock Exchange, both on NSE and BSE. But every company is unique in the management side, in the product side, in the service side. But how do we ensure that the market being valued in a proper way and we use a market approach in the right manner? So I'll just cover this topic in a subsequent slide. So quickly, I'll just start presenting my presentation. Just give me a second. Can you see my screen?
We can, but you can go into presentation mode.
Yeah. Just a second. Is it better?
Yes.
Yeah. So, there are two types of valuation methodology in per se. One is the intrinsic value, one is a relative value. Intrinsic value is nothing but, we understand from the cash flow and future projection of the company, and another is a relative value. So right now we keep hearing, the companies being overvalued, companies are overvalued. But single assumption is there, market is always right. In a long term, market will be, give all corrections and being value the entire industry in a particular way. So say just take an example of Infosys, just for no. Many people say sometimes Infosys overvalued and sometimes it's undervalued for some people, right? How do you ensure that some people say the company is Infosys overvalued and some people say it's undervalued? So what people does or advisor analyst does, they take a understanding of the industry, say IT industry per se. So what they do, they compare the all the relatives company of the Infosys, say TCS, Wipro, Mindtree, and other peer company, and understand what multiple they are trading in the industry, which is called as a relative multiple. So what exactly happens in the calculation part? Every company being valued individually and try to understand which like how the industry been valued, say IT per se. Like suppose now the Nifty also, sometimes we say Nifty price earning ratios went above more than 30. Like what is the reason? Like Nifty's ratios went above. So the Nifty's classification from the different industries, and say IT overall the valuation of the IT is a move from them say 15 multiples to 18 multiples. So this is how the Nifty is the industry is valuing the IT industry in this booming era. So that is a relative valuation. Another is now DCF approach where intrinsic value. So not only the company's cash flow is important, but also the management transparency is also important. So the management the cash flow which we draw, which tell about the capability of earning capability of the company in the future. So these are the two different approaches which usually being used in the industry for the valuation. I hope I'm clear. Hello.
Yes, please go ahead.
Yeah, thank you. So now the important topic is, why do we use a market approach? So many accounting standards and in fact IVS also recommended using observable inputs and the market approach. Why it is necessary to by using a market approach will give a value or a comfort and risk cover where compared to the other valuation methodologies. So the market is a such like the valuation is a differ from person to person. Everyone knows, but market per se, if a company being valued in the market, the presumption is the entire segment in valued in a such a way, the market capturing the all information, the industry growth, GDP growth, country growth, company growth, and everything. So that's why the more if we use the more market approach and the observable inputs, so it will reduce the value or judgmental call, right? Applying the new like whatever assumption we use in the DCF approaches, like which are the very subjective and which are very judgmental, subject to the auditors and subject to the valuer. So in market approach, it reduced drastically rather than a valuer being applying his own judgment. He considers the market views on the valuing a company. Now, as Mr. Someone mentioned, the identifying the peer company is a bit challenging, right? So how do you identify? How do you ensure that we should pick up a right company and right peer company for the valuation purpose, and we should calculate the proper say market approach and a multiple to value our client or value our target. So one of the important factors is identifying the right company. So how do you ensure that the right company may identify in a right manner and the calculation should happen in the right manner? So usually we use a lot of databases to extract the company's information and the company's peer company. So one of the sources we first ask the client just give us the your competitors and comparable. So many clients say we don't have any competitor comparable. But how do you ensure that we should check the market and we should compare the market? So I'll just quickly say how do you identify the target. So first thing, we should focus on the geography. let's say if if we are valuing a company which is operating in India, so we should take a peer comparable who are based in India and who are operating in India, because this is one of the best criteria we can use. Many valuers suggest that if we don't have the comparable in India, so we can we can consider the comparable from the different geographies, say America, North America, Europe, and other Western countries. But those parameters are applicable in case of startups and not for the matured company which are operating in India and which are fair enough being a traditional business in India. So I'll just quickly just give a 2-3 websites where you can identify the companies and peer companies for the clients without using the databases. So one of the say one of the website we use is a screener.com. So this is one of the best freely available databases where you can identify the peer company of your companies. Say now if you are valuing an IT company and you wanted to understand, like if we have any peer comparison in the IT company, so you can identify say one company compared to the client which is a peer company. Now if we mention just for the XYZ, Wipro is my peer company or comparison company. So if you can search Wipro here, you can get a peer company in this list, or you can identify by the comparison in the sector and industry.
Mr. Amit, we are not able to see your screen if you are trying to share the screen, sir.
Oh, sorry, just a second. Can you see?
Yes, we are able to see now.
Yeah. So this is a screener.com. Okay, a .in. It is freely available in India. So if you can say, as I mentioned, if you know a single company, comparable company of your target, right? So you can search in a single company here, and you can identify the peer company from this database. Now you can see, this company has been classified as the sector as IT, and industry is a computer software as a large. Based on those parameters, you can edit and search.
Does the screener have information only on listed companies?
Yeah, this is for the listed companies.
Only for listed companies?
Yeah. Only for listed companies. So I'm trying to cover first listed company, which is a CCM. CTM is a bit challenging because a lot of databases also which we subscribe don't provide the detailed information about the transaction. So we are end up leading the Google research and a lot of databases research and the industry association magazines, where we understand, suppose if you are valuing a company, so we understand which are the recent transactions happen in the industry, and based on those information we calculate ourselves transaction multiple. Yeah. So the important factor is identifying a company is a bit challenging, but there are a lot of free databases where you can access the company information and the peer information, like to understand which are the competitors and the peer companies have been involved in the similar kind of businesses. So there are multiple categories and the filter which we can utilize to identify the relevant company and the relevant target for the comparison purpose. So one of the criteria is geography, as I mentioned. After geography, the important criteria is sector and industry. So what we observe, multiple, say a particular, if we are valuing a company, so after identifying sector and industry, so we use a lot of keywords about the product and services about the company. Say, just for example, we were valuing a chemical company. So the chemical industry is very big industry. So you need to understand that chemical has a different segments also, which is a commodity segment, bulk chemicals, and special chemicals and everything. So based on the client requirement, what we do, we understand from the client, which category he belongs to, whether it's a specialty chemicals or bulk chemical or any other chemical. So based on those requirements, we filter the industry, and after filtering the industry, we identify by using the product and service description of the target. Now, post identifying the company, certain companies, so we need to ensure that we are comparing the right company and the right size. So post that, we utilize the say we filter the company's criteria by using the various fundamentals, the revenue size, the EBITDA margin, the PAT margin, company presence, which have been available in the databases, or you can identifying say certain company, 10 companies, and you can do a Google research, also simple research. You can identify that those companies are being categorized in a different categories. Now the important factor which we consider while valuing the market using a market approach is considering the actively trading company. So what happens, like many valuers use a market approach, but they don't check whether those companies are being actively traded or no. So one of the basic criteria, you should understand, if the company is not been actively traded, so it may be possible that the company's valuation may compromise in the market as a single company. Am I clear till now? Hello.
Yes, Mr. Amit, we follow you.
Yeah. So now the interesting part comes about the calculations. So now we have identified certain companies. So calculation is a very pretty important part in the valuation. Many valuers ignore certain kind of assumption in the market approach. So first thing, while valuing a market approach, we should calculate the multiple by us own, like rather than taking a valuation multiple from the free databases, like I mentioned about the screener and the other database EDLV or money control. So many valuer, what they does, they consider the direct market given multiples, and they apply that multiples for the valuation purpose. But there are certain hidden risk areas for the computation of the multiples. So I'll just consider the practical example, which will help to understand, what are the issues we face during the calculations. So first thing, we like everyone knows, we will always compare the enterprise value, which is the equity value plus surplus asset minus debt. So sorry, equity value plus debt minus surplus asset. So that will be the enterprise value. So now calculated for the calculation of the equity part, what we consider, so we consider the market price of the company and diluted number of shares. Now in this area, the challenge is what should be the market price, whether the market price should be the as on the valuation date or as on the date when the valuer is actually in the valuing company. Say suppose if you are valuing a company is for a period of 31st March 2021, and we are valuing in the month of December. So what will be the market price you should consider, whether 31st March or 30th December? If anyone can just answer.
It should be valuation date as per my view.
And why do you think so?
Because we are valuing our company as on that date, and when we are comparing for the other company, what is the value of that company on that particular date?
And so I'll give you a classic example for this. We know the COVID happened in the month of March itself. After 23rd, the lockdown happens, and as on 31st March, right? 20. The stock price of every company was corrected by say almost 50%. Correct. So what happens in that scenario, panic situation? So you may not be get a correct picture of that company if you are valuing for 31st March 20.
Okay.
Okay. So what usually we do, so whatever, like suppose the company, say XYZ company, we are valuing that company for 31st March. But many times what happens, the companies are result being declared in say June. And if you see a lot of action happening post result and pre-results. So actual real picture of the company will identify at the time of June when the results are out, right? As on 31st March, you don't know about the company, what will the performance and what will be the activity company is doing.
Correct.
Are you getting my point?
Correct.
So ideally what we do, so like you are valuing a company, you have the all information, necessary information for, the performance of a company, result of the company for 31st March. But for the listed company, you get an idea when the result get published, right? So usually what happens once the result get published, a lot of action happen and a lot of valuation correction or maybe no improvement happens during the result period. Say now result is on the 25th June. So if you will see the stock action, from 20th to say 30th, say in that range, based on the results. So the one of the important issue is considering the market price. What should be the market price? Whether it is the 31st March or whether it is a result date or whether it's a date when the valuer actually valuing the company. So many valuer follow a different practice. But after discussion with a lot of valuer and a lot of industry expert, what we understand the result date is a more conservative basis to value any company. Like it give you a real picture what is the actual result of that company and how the company is being performing. And another important point is considering the number of shares. So what happens, many valuer consider the number of shares being presented as on the balance sheet date, say, but they don't check or analyze the balance sheet whether the company is having any share warrant or any other convertible instrument or any other which will dilute the company's share capital. So we always should consider the diluted number of equity shares rather than considering the balance sheet equity number. So these are the both gross mistake, like majority of us we do. In fact, we have done this mistake in our initial days, and then eventually we have corrected ourselves while valuing the subsequent valuation. So we have identified the say now equity value. After equity value, we have to arrive at just a second.
One doubt
Yeah, sorry.
on this. One doubt on this convertible instruments.
Yeah.
You said then the convertible instruments we need to convert diluted equity. We need to convert to get the EV.
Correct.
Yeah. But suppose sometimes convertible instruments the conversion portion is not mentioned. They just only they say taken the money saying that it will be converted based on the valuation report obtained at the time of conversion. So in such cases, how do we get this diluted equity?
Sir, if you can see, the company always mentioned diluted EPS.
Correct.
So based on those diluted EPS, you can reverse calculate and you can arrive at the diluted equity.
Okay.
Okay.
Mr. Amit, I joined about 5 minutes late. Can you please summarize what happened in the first 2 or 3 slides, sir?
So quickly, we discussed first why do we need to use a market approach and what are the challenges in the market approach. The many people say the currently market are being overvalued or market being undervalued, but the market it's always right. Individual script may be overvalued or undervalued, but it's a market per se. It's a basic assumption. Market been always right. So first assumption was, market is always right. So using a market approach will be the reduced valuer, risk and the judgmental issues, and he can be rely on more on the observable inputs rather than focusing on the various assumption which we use in the DCF approaches. So post that we identify how to identify a company while valuing the market approach. So one of the challenges is identifying the peer company in the valuation. So there are different criteria we use for the valuation, which will be say first we filter by the geography, then we filter by the industry, then we filter by by product and service category, and then we filter by the revenue or other market cap or other parameters to identify the real peer companies for our client. Then post we discuss about the calculation part, where the equity value, how do we calculate the multiples. So many valuer consider the multiples from the databases which are freely available, say money control or other databases. But usually we try to calculate by our own to avoid any subjectivity in the calculation. So one of the issue we discuss about the considering the purchase market price of a share, which market price should be considered for the valuation, and how do you arrive at the equity value. So this was the discussion as of now.
Thank you.
Yeah. So
Amit, I want one clarification regarding you told that we should take the diluted equity. When we are taking the comparable company, the share prices which is quoted is based on the undiluted equity capital, which I understand.
So market always capture this information about so market always consider that the equity which has been the equity has been diluted equity. You are misunderstanding from the split and bonus. So what happens in a split and bonus, whenever the company issue a split or bonus share, then market price being corrected.
Okay.
Right. But what happens if the company is having a diluted equity and there is no change in the split and bonus or capital structure of the company, the share are being traded in a similar way.
Okay.
Understood?
Okay, thank you.
Yeah. Okay. So so now we have arrived at the equity value. Now we have to calculate the enterprise value. So how do we go and arrive the enterprise value? If anyone can help me, and we can discuss about this issue, because there are multiple challenges from going from equity to enterprise value. See, in the normal practice, if you are valuing a private company, there is a simple calculation. Say in enterprise, in equity value, you add a debt and less a cash, a surplus asset, and you can arrive at the enterprise value. But in a practical scenario, what will be the challenges you will be facing? If anyone can just help me.
Can you just repeat your point?
No one?
Can you just repeat your point?
Yeah, so now we have calculated the equity value, right? How do we arrive at the equity value? Considering the market price and into diluted number of equity shares, right? So from equity value, we have to go to enterprise value. First, I hope everyone understands why do you want to go to enterprise value, or do you want me to cover that point as well?
Because we carry out multiples on EV, enterprise value.
Correct, absolutely. See, what happens in the equity value, it may not be reflect the right picture. We have to see a capital structure of a company and other parameters of a company. Hence, we calculate the enterprise value, eliminate the capital structure of a company to avoid subjectivity.
Okay.
Yeah. So now from equity value, we have to go to the enterprise value. So how do we go to the enterprise value? So like
in that case, we need to identify the surplus assets which the peer company is having.
Correct.
Getting these information is really challenging.
Absolutely right, sir. Absolutely right. So now this is one of the challenge we always face, to understand what will be the surplus asset of a company, because what happens, we always consider the operating cash flows and operating income of a company or operating EBITDA, but we'll never know what are the surplus asset of a company, right? So this is always the challenges we always face. So what we do in the such scenario, we first try to understand 3-4 areas in a very detailed manner. One is a fixed asset. In a fixed asset, we usually try to we understand the trend of the fixed asset of a peer company. Say let's say last 3 years we draw put all the numbers in the Excel and try to understand how the fixed asset turnover ratio has been working, or how the company is performing in terms of fixed asset. Another important area we consider the investment and other current assets. So an investment and other current asset, usually company deploy if they have any surplus asset, so they usually deploy that asset, and those assets been parked under the investment or other current asset. So these two area are an important area for every valuer to analyze this area to identify whether there is any surplus asset or any other non-operating asset for the company. I hope I was clear on this point.
So are you saying that the equity value,
Yeah.
the price that is quoted in the market, does not consider the value of the non-operating assets in its value?
No, I'm not saying that it is considered, sir. But right now you are valuing a company's business, right? I'll just give a quick example. So now you are calculating the company's value, only a business value, not the asset value. So company has a two type of value. One is operating
Okay.
value.
So
one-
therefore you want to subtract that part of it.
Yeah.
And quickly, you said for the equity value, you take the price which is after the results and all that. Even though valuation date is 31st March, you actually consider whenever the results came. That's what you said, right?
Correct.
You don't actually take a median of last 6 months price or something like that. There's a variation.
No, so usually what we do, we consider the say 1 week before the result and 1 week after the result to capture. See, whenever we are valuing a company, we always take a LTM, right? A last trailing 12 months. So
Correct.
what we understand, the market always capture the all information from the previous quarters. Now the market is waiting for this results, right? For this quarter. So once the quarter result are announced, right? So the market will capture and value company accordingly.
So you take 1 week, you're saying?
Yeah.
1 week before and 1 week after the result.
Okay.
So, Mr. Amit, if you can just help me with an example, if I'm actually valuing a company at November 30th,
Okay.
but you are actually taking the, and the results of our company are actually announced, let us say in October. Listed company results are announced in October 3rd week or something like that. So you are telling that when my company that is being valued is on November 30th, but I will still be taking the data when the results are announced. That is, all the action that happens, say between October 25th to October 31st.
Yes, see, ideally how the market look at the company, say now maybe what happens post October to November, there will be separate changes. And because of those changes, the stock been performing, right? Say government announce certain policies for a particular industry, right? And based on those industry parameters, the stock is performing in that direction, right? But actually, you need to understand how the market is being valued based on the results, right?
Correct.
So as on date of result, you will have the last trailing 12 months of the revenue of the company and all the performance of the company, right? So based on those parameters, you will calculate the multiple.
Okay. Will you also show us some sort of a live example? I mean, if you can help us so that we'll be able to relate to it better.
Definitely. I'll just going through the presentation quickly, then I'll take live example how to value a company. So I have the database data collected, so I can quickly show you the how we have filtered the company and everything. Okay.
Amit, one more thing. Suppose the peer company, the comparable company is having a multi-product company. So in that case, how to segregate, take the figure from that, because it might be possible that they are that company is performing differently for the different product. So that challenge will also be there.
Sir, you always need to understand, like suppose while selecting a company, as I've said, we need to understand the product and service. So maybe you can understand the segmental reporting of a company, whether the company is reporting a different segment, because it is pretty difficult to understand the product portfolio of a company and the revenue metric. Maybe a single product can generate say 10% revenue, right? But and your company is 100% involved in that segment. So this is a bit challenging, identify the product wise revenue and a product wise or service wise revenue of a company. So usually we assume that based on segmental reporting that the company is relatively comparable, and may not be 100% be comparable, but at least it will cover 60 to 80% of the chances to being a relevant company for us for the comparison purpose.
And another question that I have is, again, in the market, there are various companies of various sizes.
Correct.
Your comparable company, some companies may have 100 crore turnover, and some other company might have even a 10,000 crore turnover. Correct? When it comes to listed companies, I'm telling. So, and how do you kind of adjust for these size differences?
So yeah, so we consider the multiple. Say usually what happens now, we consider at least 3 to 5 companies minimum, and based on those, like suppose we understand what are the range of the company. We understand from the revenue, we understand from the market cap. So based on those, we actually calculate the median, and based on the median, we do a lot of adjustment. I can show you at the later part of this part of the slides.
Amit, one more question.
Yeah.
The company which you are valuing is having a multi-product, and it may the combination may be. In that case, how you are going to choose the comparable company?
Sir, I need to understand my like from a target, which is my more relevant product, like which is driving the main company. Like say a particular product or product segment will be driving company. Say 60% revenue will be coming from that product. So first, I will try to identify that 60% criteria product relevant company. So this is one of the classic example. What happens? One of our client, which was engaged into the elastomers elastic rubber, and which again involved in the garment segment. So he was a combined segment of the rubber and the say for the apparel segment. So what we try to identify, few company from apparel and few company from the rubber segment, which are operating into the apparel segment. So those, like you need to understand what is the revenue mix of your target, and based on those target parameter, you can identify and you can also blend the comparable companies. I hope that's clear. Sorry.
We are good, Amit. Please carry on. We understand.
Yeah. So now, as we mentioned, we have to move from the equity value to the enterprise value. So one of the challenges is not to understand the non-operating cash and the surplus asset. Another challenge, what we see in the many valuer does mistake in calculating the debt portion. So many valuer consider only debt of long term and short term, but somewhere they miss the calculation of the current maturity of the long term debt, which are being parked under the other current liabilities. So this is a gross mistake we usually do. Same the mistake we have done in our initial days, and then eventually we have corrected ourselves. So for the calculation of debt part, we consider the long-term debt plus short-term debt plus current maturity of long-term debt. Also, we quickly scan the cash flow if you are missing anything in terms of the debt or in terms of borrowings. So these are the few mistakes we do while calculating the enterprise value of a company. So which we have highlighted. Now going further.
Amit, value of the date is taken as the book value of the date, or any other method you follow?
Sorry.
The date value of the date. You go by the book value of the date, or any other method you follow?
So usually we consider market value of debt, but how do you arrive at the market value of debt? There are two types of calculation. One, if the debt is being traded in the market, we consider that market value. What will be the redemption value? And if the company is having a short-term borrowings, which is a working capital, a long-term borrowings, which has a stable outflow. So we usually consider then the book value consider as only this is the company having only liability.
So how do you get those data? I mean, how do you find out the market value of the debt? And also, I think do you need to consider the debt-like items? There are many debt-like items in the balance sheets. Will it form part of the debt, or it will be not taken?
This is an interesting topic. Debt-like item. First thing you mentioned, debt-like item. But how do you calculate those debt-like item? You don't have.
Yeah.
you don't have the all the inputs for the calculation of a debt like item. Like say for diligence purpose, we do a more than 90 days creditors. We consider the debt like item.
Right.
But usually you don't know how to arrive at the aging for the company. So we assume that these issues like which were the debt like items and certain surplus assets, like in surplus assets we consider advanced tax as a surplus assets for a company, and provision for tax we consider a debt like item. The delta will be the company's liability or delta will be the company's assets. So those nitty-gritties are always there in terms of arriving at the enterprise value. But the debt like items and kind of such other relevant expense relevant heads, we assume that the market is always captured considering the working capital cycle of a company. Say particularly a company being traded with the working capital of I'll just give a classic example of a listed company. One is a Team List, another is a Quest Corp, and another is a SIS. Okay, if you see the working capital of Team List very short, and you can observe that in a Team List multiple are being traded very high valuation. So market always capture the working capital cycle of a company while valuing the company.
No, that's true. But the point I'm trying to drive at is, since the standards prescribes this additional point, how do we justify in our report that we have done it correctly, or at least I've been saying that these are not taken, though something like that. If you can guide us on those issues, it would be better, because standards specifies both the standards, both CA Institute standard as well as IBS specifically mentioned this point.
Sir, I do agree with you on this point. So usually what happens in those certain criteria, at least we can scan the annual report of a company, and we try to understand how the value the balance sheet been drafted in annual statement. But sir, it is bit challenging. You won't get all the information, like debt like item you mentioned, right? Now, how do you ensure that the company's trade cycle is 60%? Like I have the credit period of 120 days, right? So which is my normal credit period, and another client is having a credit period of 60 days, right? So if you calculate the number of days as per the sales of a creditor, one will vary from 60, one will vary from 90, but actually he's having a credit period of 90 days with the client or with his vendor. So it is very subjective and very judgmental call you have to take while calculating the debt like items.
But how do we mention in our report? If I know it, what you are saying, sir, I agree. But how do we mention in our report that we have dealt these items like this way? I mean, like I said, I told you about the market value of debt as well as these debt-like items. These are not, as you also said, they're not easy to go find out. But how do we deal these issues in our report?
Sir, for debt like item, I can surely tell you, if those parameters being captured in the working capital. So while calculating the market, like now suppose a debt like item you are mentioning, same debt like item will be captured in the working capital, and because of the working capital, my multiple are been changing accordingly. So we can mention the company like while understanding the different multiples, like some company having a multiple of 10 also, or some company having a multiple of 15 also, right? So those 15 multiple companies, maybe it is correctly valued, but the company is operating in an effective way, which is now they are utilizing the working capital in a correct manner. So this is a very what I can say, like we always try to defend ourselves saying so the market valuing a company and that this debt like items are being properly captured in the working capital, rather than we can't individually calculate because of the limited data.
But we are taking long-term and short-term debt, not the working capital, right?
Sorry,
we are taking long-term and short-term debt. If you can demonstrate us something in Excel or any other separate this one sheet, it will possibly help us. Nothing else. You can carry on then in that case.
so
Because one particular case, I felt a lot of problems And finally, very difficult to draw a report saying everything that I have followed my IVS so and so. So it will be really challenging. I mean, long term and short term doesn't say is the working capital, right? So you have to add those. What? How do we go about it?
Sir, I mentioned that we have to add long term, like date is a date. So we never classify date in a, whether it is a working capital or a short term date. So whatever date company is having is on the date of the, valuation, is on the date of the valuation date, right? So we consider all date and we subtract the date from my EV while arriving at the equity value.
And debt like we do not take debt like items in those cases, right?
Yes, sir. So debt like item in the market approach is very difficult. Like you can't, it's relatively impossible to get a data unless and until you are the auditor of a company and understand all the parameters and the financial of the company. So it is relatively impossible to get debt like items.
Do we need to mention all this in a report?
So usually we mention that, we have followed this process. We have calculated our EV based on these parameters. And we assume that the market being valued this company and based on the working capital requirement, and hence the multiple are being calculated accordingly based on the market.
Okay.
So we definitely put a disclaimer and a caveat saying, this is our process.
Okay, sir. Okay, Amit, thank you.
Can I uh, discuss something on debt like items and also the about debt?
Yeah, sure, sir.
So when it comes to debt, you need to consider all interest bearing debt, both short term and long. You don't need to make any differentiation between short term and long term.
Correct.
That is one thing. And second thing is that preference share capital is also a debt equivalent. You need to consider that in the debt part. The second and the other thing, when it comes to debt like items, some of the items can be easily identified. Like in India's scenario, lease liabilities are considered as operating leases are considered as debt equivalent. That part you need to adjust. And your pension liabilities like gratuity provision and other things are debt equivalents. And deferred tax liabilities, sometimes if it is arising on account of non-operating items, they are also like debt equivalents. All these things can be adjusted. But having said that, consistency is the one of the important parameter in market approach of the valuation. Your multiple and the parameter, the numerator and denominator should be consistent. In a way, when you include certain items in your EBITDA, you should also include all the related items in your EV.
Correct. Sir, I do agree with your point. Like this is possible when you are doing a valuation for the particular, say, balance as on the balance sheet date, say on 31st March, right? But getting this information for a valuation, say if you're doing a valuation for say on the month of October, right? So for the month of October, getting a balance sheet, you have to take a balance sheet of second quarter.
Second quarter.
So this is a bit challenging. We also like you can scan the balance sheet and you can identify the date like item, but you're not sure, as on the Q2 whether this item are being carried forward or whether there is an adjustment of with those items.
Very difficult.
Yeah. So like we can't, say with a particular company we provide one judgment and with a particular company we provide another judgment. We have to follow consistency while valuing the peer company in a one shot. So that's why I couldn't mention, like consider the annual report. You can consider the annual report, but as on the when you are valuing the company as on 31st March. But again, there will be the issue with your reporting part. One time you are considering these parameters and one time you are not considering these parameters. So hence we follow consistency in our process also.
Amit, if you can also throw some light on how practically you deal with the market value of debt, how we arrive at.
Sure, sir. So market value of debt, now market value of debt, you can if the company is being their trade shares and been traded, so this practically happen into the terms of NBFC or infrastructure company, where you can identify those companies are being their market debt being trading into the market. Now another point, considering the market value of debt for say companies who are having a debt but the debt is not trading in the market. Just for example, give me a second, I'll just check in my previous working if
I will give you one example so that you can understand my question. Suppose I am valuing a manufacturing company and it's a cash-starved company, right? And obviously, possibly they have taken debt at a higher rate of interest, and there are lots of items. There are so many creditors not being paid and on time. So there are so many things. I mean, there's a imbalance in their cash flow, basically. So how do we go about those companies for that?
So, sir, creditors, they are not paying creditors again.
No, that is debt-like items.
Correct.
We covered. That is okay. But the debt, the market value of debt, how do we about?
Sir, again, the market value of debt, we need to identify, like while calculating a company, right? You have to say what is the actual liability the company has to pay in terms of debt, right? So the market value of debt, first thing, whatever the principal or whatever outstanding they have is on the date of the valuation would be considered.
Can I say something?
Yeah.
Yeah. Whatever my understanding is, typically, if you have taken 100 rupee loan at a particular interest rate of 4%, and I'm rated BBB. For a BBB, if the market rate normally for a particular company, listed, unlisted, depending on the category, it should be at say 9%. And your loan is for say 5 years. So there is an interest arbitrage for 5 years to that extent. So you do a discounting of that interest arbitrage. That is what is you add up to the debt or subtract to the debt depending on where you're standing. That is how you calculate the market value. So mostly if the debt that you have is a variable rate, and if the rate is almost equivalent to the market rate for a similar corresponding entity, then market debt is equal to the book debt. So one has to just look at that and then look at typically corresponding to that rating, what the interest rates in the market are and what this entity is getting. And differential in that interest is the basis on which you determine the market value of debt. Trust this clarifies.
Thank you. I hope.
Please go ahead.
Yeah. Okay. So, yeah. So for on the calculation part, now the another important part of the calculation, considering the trailing 12 month of a company, like one of the challenge we face in this discussion, identifying the actual date of the company and date like item and the trailing 12 month of revenue of the company. So while valuing a company, what usually we do, we always consider whatever the latest quarter's information available. We consider that those quarter information available information and their last 3 quarters or 4 quarters information while comparing the EV/EBITDA. Now, one of the important point which we discuss during this discussion, how to ensure that the market like multiple are being properly being captured, and this debt-like item in properly resolve the issue of the company's valuation metrics. So there are different kind of issues we face during the identifying the valuation metrics. Every company has a different value multiples, but we need to understand what are the reason behind this different multiples, like a company being throwing in multiples valuation and another company being throwing a multiples of say 15 multiples. So there is a drastic changes in the 8 to 15 multiples. The reason behind this will be a different reason. So we need to understand the reason, whether actually we have miscalculate the this calculation part, or the actually being company being valued at those multiple which we have calculated. So the one of the reason what we identify now, the difference in the multiple is due to following reason. One, the difference in the fundamental. The fundamental can be a management quality. Say a particular clean management will be drawing a good multiple in the market, and another company with a similar business, with a similar operation, with a similar activity will be drawing a less say multiple due to issue in the corporate governance. So we understand whether those company, whether we need to consider for the valuation purpose, or whether we have to exclude those as an outlier company, and we can reject those company based on these parameters. One is the management quality. Another, if we have any market information, like whether if they have filed any information on the BSE NSE for the future contract, or bidding for a future contract, on bidding for any future activity. Another is the working capital cycle, which we discussed earlier. So this is the one of the important factor we consider while finalizing our peer companies. Another is a accounting policy differences. So one of the important point we focus, what are the company we are considering, and comparison purpose. We understand that whether their accounting policy are differ. Like whenever we consolidate all 4 or 5 whatever the comparable company we identified, right? So it should not be happen a particular company is being valued in a particular way because of the accounting policy also. Like the revenue recognition policies may be different, and based on those their cycle is different. Another important point what we understand, classification of the say bank charges. Now say bank charges, many organizations classify as a finance cost, and many organizations classify as a operating cost. So this is a bit challenging for us to to understand whether the banking charges has been properly classified, whether it will be considered as a part of the EBITDA, or we should consider exclude this part from the from the EBITDA. So this analysis we can understand from the annual report, and we try to understand what is the quantum of bank charges if it is parked into the finance charge. Usually bank charges are being always classified as operating expenses. And another reason is mispricing of the multiple is either the company is infrequently traded, or the company been there is insider trading, or there is the operator driven stock. So for those parameter we can't help it. Actually we kind of we consider those company, those parameters are very outlier. So we we try to understand if we can't find out the reason. So we consider the median while calculating the comparative analysis, and those company automatically been rejected while calculating the median. Now like many people mention, and in fact I just mentioned, I know we consider the median. Why do we consider the median or the mean while after considering say 4 or 5 companies for the valuation purpose? Why do we consider the average or a median of for those 4 or 5 companies I use as a benchmark? If anyone can help on this point.
Can you repeat it?
So I'm just asking, like, suppose we have identified 5 companies, right? So now those 5 companies multiple we got from this calculation and working. Okay. So how do you which multiple you will consider? Whether you consider the average or whether you consider the median? If you wanted to consider average, why? And if you wanted
if there are if there are no outliers in your data,
okay,
so you can consider mean or average. If
correct,
there are outliers in your comparables, it is always better to consider median.
And how do you identify the outliers?
Outliers you can intuitively you can identify. Otherwise, you have to perform some statistical score like Z score or something like that.
Achha. See, outlier usually been you can see the range of the multiple also. right? So if suppose few company are being valued at 15, 18, 20, 21, right? And one of the company being valued at 80 multiples because of the high growth or something like that. So those company automatically, if you consider the median, so those company automatically been rejected by the median, and the average of those nearby companies has been considered as the median point. So now you can see, like, we have considered say 12 companies for the comparison purpose. So every company has a different year end, and the company we have considered the different financial dates. Say for company A, we are having a data till 31st March while valuing the company, and for the company for another company we are considered the 30th September, right? So this year end companies comparable, like, maybe first one is the 19, first 31st December 19, you just ignore that 18 number. So what I'm trying to tell you that, for the rate of valuation, you may not be you may not be get a result of all companies. Say out of 5 companies, you will be getting the result of the 4 companies, and 1 company is still awaiting. So you can consider the whatever be the last available quarter data. Going further, so you can see now in this working, so we have calculated both average and median. So average is being considered, like average is again because of the no outlier, average is come in 14.5, and the median also somewhere around 13.4. So we will just go into those calculation. I'll just quickly give you just about the presentation, then immediately we jump to the calculation.
In this slide, enterprise value is a derived number, right?
Yeah.
Whereas, maybe EBITDA, revenue, trailing 12 months, EBITDA for trailing 12 months, equity value. Equity value is also a derived number. Debt is, you would have considered from the balance sheet of the company as on that day. So equity value and your enterprise value would have been a derived number, right?
Correct. So I'll directly jump to a calculations now part. Can you see my working?
Yes.
So because of the shortage of time, I just considered my previous working only, where now in this category we are unable to find out the market say comparable company. Still what we have tried to understand, we have we were able to collect the CTM transaction but not the comparable company, but somehow we collected few companies with the comparative parameter metrics, and we try to understand how the market is valuing this segment. So what we have done, so we have shortlisted first based on the from the description of the industry. Say this company are being classified as a chemical industry because this is the specialty chemicals, which is adhesive. Post that.
This is on which date, Amit?
So this is 31st March 20.
Okay, yeah. Okay.
Okay. So so for this purpose, so how do we filter this company? So we have considered the complete list from the database. Just hold on. If I have the data, I can show you quickly. So we have what we do, we use a lot of databases. So in one of the databases, we search from the industry criteria, and based on the industry criteria, say we get 100 companies, and after 100 receiving that 100 companies, we filter those 100 company from using a keywords such as product description, segment description, or application description, and we identify and select few companies and eliminate the other companies based on those description. So after identifying those companies, we again further analyze based on the criteria as I mentioned in the earlier slide. So after doing all these calculation, we have identified these 3 companies. Now for the calculation part of this company, we have done the calculation. Say now we have calculated the market capitalization. So you can see latest available end year is 31st March 20. So number of equity shares is on this date is this number of shares, Now result date of company is 29/6/2020. Okay. So this was the assignment where we have considered the single date because we are not applying this workings in our final calculation part. Is just to take a comfort whether we are valuing company properly with the income approach and with the CTM approach. Okay. So you can consider the market price. You can see that we have considered market price as on the result date. So what we do, we extract the complete share pricing of a company, and based on the share pricing, we consider the result date for our calculation purpose. Now, post considering the market price, we have arrived the market capitalization. And
again, when you say result date, day end result, is it? I mean, day end price on the result date. Is that what it is?
Suppose if result come into the market as we consider that day, and if the result come after the market, we consider the subsequent day.
Okay.
Yeah, but this was earlier. Now, what we have tried to reduce subjectivity, we have considered, at least 7 days before and 7 days after from the result day to avoid the subjectivity. Okay.
When you say 7 days before or 7 days after, you're taking only one price, right? So you'll be taking 1 week after the result date, whatever is the price, and that too, will you take the average price or the will you take the day end price? Because see, price always is very, very dynamic, right? So what is the position that one needs to take?
Closing price, closing
price after the 7th day after the result.
Yeah.
According to the assumption is that the market sentiments would have settled and all the corrections would have taken place in that 1 week period.
Correct.
Okay.
Then the market date value. So we have considered the book date because again, as I mentioned, this is just for for the confirmation purpose, not for the valuation purpose. So else we would have considered the market value of debt also. But for the calculation, for ease of quick calculation to understanding purpose, we have considered the date as on the date of valuation. Then post that, we have arrived at the enterprise value. So in this scenario, we couldn't find any surplus assets like non-operational assets or any other assets. So after considering the enterprise value, we have arrived at the trailing 12-month revenues and trailing 12-month EBITDA. And now you can see this company with the lower EBITDA and negative PAT being valued at the multiple of EV/EBITDA of 64. Whereas this.
What is the formula for EBITDA percentage and PAT percentage? It is
revenue percentage to revenue.
So EBITDA divided by the revenue, is it?
Correct.
Okay, and PAT is also the same thing.
Yeah, if you can see the working. So, the total revenue divided by EBITDA.
Okay.
Your valuation method of calculating, is it not in contradiction to how SEBI asks you to value typically, if any acquisition or any such kind of stuff happening?
Sorry, sir, I couldn't get your answer. Like, what contradictory you are mentioning? If you can just highlight something.
See, SEBI, suppose, for example, if you are supposed to give an open offer or any valuation that SEBI tells you to do for listed entities, they said you have to consider 14 days average, or for actively traded, or 6 months. There are certain guidelines.
Correct.
And what I understand is you are doing a valuation based on the result date, which is much later than the valuation date.
Correct.
So is it not in contradiction to what SEBI's valuation method is?
Sir, in this per se, when we are doing a private valuation, so SEBI has a separate parameters for the listed companies. Now I wanted to see investor sentiments in terms of the private company. Suppose the investor sentiment will change when they see the actual result of the company. I agree with this point, but this just for example, in income tax also, income tax say a particular way of method of calculation, which everyone knows it's not a right way to calculate the company's fair value, right? The 11 UA part. So in a certain regulatory aspect, we do agree, we deviate from the regulatory aspect in terms of the actual calculation of the valuation when we valuing the private company.
Second principle here is your presumption that just because a result come in, then only people actually value that. Prior to the results, people do not have an inkling of the direction of the company. That's a presumption we are making here.
Not really, sir. That is the only presumption. People have idea about the company. Say a particular company, like it's being valued at a decent price, but because of certain parameters happened in the last quarter, say whether company has introduced a new product in the market which was not known earlier, or certain happened in the management team, or something happened in that quarter, the company the valuation can reduce drastically or increase drastically based on those parameters. Like you are valuing your target company, you have the all information, which is the last 12 months your revenue, right? So you should consider the identical way of valuation for your peer companies also, what we understand. So again, sir, it is a very judgmental call. Like, every valuer does like many valuer consider the as per the SEBI guidelines also. Many valuer consider the 31st March as a cutoff date only. But this is something practice we have developed over a period of time after a lot of discussion with the experts and a lot of discussion with the various investment bankers when they approach to the investor how they consider the valuation metrics for a listed company.
Okay, thank you.
Yeah. So, so you can see that so this company, because of the lower EBITDA margin being mentioned as a 64 times, and both are these two companies are being valued at say at a near about relative range. So this is something like the market approach. If you are not using the market approach, at least you can use those approach to evaluate whether your company, like using an income approach also, whether you have actually corrected value using an income approach for your target company. Now I'm going to the last slide, which is a very interesting slide for the adjustment per se. Just to hold on. Yeah. So someone asks, how do you consider the consider a discount or a premium for a company, right? So these are the very subjective matters. So we have developed our certain internal parameters where we value, we provide the discount or a premium based on a few criteria, which will be the first will be the management criteria, another will be the size criteria, another will be the liquidity criteria, and another will be the product and the market size criteria for a company. So these are the few factors we actually consider while giving a discount or a premium for a company after arriving at the EBITDA. Suppose now we have arrived in this case, we have arrived 13.4 million EBITDA, right? So this part, after arriving at the median EBITDA, we apply a certain discount on the premium. So every valuer has a different methodology to calculate. So there are certain scientific formula also to calculate this number. But we also internally have developed certain parameters where we consider the 4 different categories, and we weight those categories in such a way that we arrive discount or premium in a arithmetical way. So every valuer should consider these parameters while giving a discount and a premium. One is the company's financial performance, growth. Another is the liquidity and stock, liquidity of the stock, whether your stock is illiquid. Always, if you are valuing a private company, the stock is always illiquid. Restriction or transferability. So many company has a restriction on the transferability. So we should consider these parameters while valuing a company. Another is a market share, distribution network, market size, generation availability of the cash. Also been considered as one of the premium. If your company is able to generate a decent cash flow than the peer company, you can give a premium also. Percentage of stake under consideration, company management and decision making, intellectual property rights if the company has any intellectual property rights, and again customer concentration and supplier availability. So this is the final calculation part. Now, see what happens whenever you are valuing a company, private company. So it may not be necessary that EBITDA, reflected EBITDA will give a correct picture. You can calculate the first you need to understand whether the presented EBITDA, whether it reflects the correct picture of the business, or if there are any hidden non-operational or non-operating expenses or one-off expenses, or even promoter expenses are being captured, because ultimately a private company operated by a very close environment. So there are bit challenges, where you can identify certain expenses have been parked, and due to which your EBITDA has been declined significantly. So in our previous practice, what we have identified, one of the biggest reason management remuneration. So what we understand from the client, whatever the remuneration they have taken, what is the actual market remuneration they should get, despite of actual booking in the financials. Am I clear on this point?
Yeah, thank you.
Yes, yes.
Yeah. So the adjusted EBITDA is required to calculate for the comparison of purpose for our company, for a target company, because of the private in nature, there may be a certain expense which has been classified. So you can see from this calculation, the comparable median. So we have considered the comparable median for 30.4, and we have applied certain discount, which is a liquidity discount and the size discount. Suppose that we have arrived at discounted multiple. After that, we have considered the adjusted EBITDA. Say adjusted EBITDA is 76.6 based on the above calculation. And post that, we have adjusted the debt and debt-like items. So debt and the cash and cash equivalents. So after that, we have arrived at the enterprise value. And for the ease of calculation, we also take sometime forward for 1 year forward multiples, which is the ideal way, how the IPO company are being valued today. So while valuing an IPO company, usually the investment banker takes the forward multiples. So the forward multiples are usually available in the Bloomberg database, or say I think it is available freely on the Yahoo also. So for the correction part, we can consider see for the confirmation part, we can consider this the forward multiple also.
How did you arrive at the discounted multiple of 12%? No, your comparable median multiple is 13.4, and then illiquidity. Can you please explain how that 12% is arrived at?
Yeah. So so now if you can see from the above working, we have arrived 13.4 is a median. This is a median, right? A bit median multiple. Post that, we have adjusted this median multiple based on our targeted company's valuation. So as you are the private company, right? So the illiquidity discount, right? So you have to apply a certain illiquidity discount because your share easily not been sellable into the market. You have to do a lot of activity. So this illiquidity discount we have considered whatever the commission or fees charged by the broker or by the by the say advisor for arranging the sale transaction, arranging the investors. Suppose in the listed company, you can easily purchase and sell, right? The shares. But for the private company, it's very difficult, whether you can get a immediate transaction or no. So what we have considered the liquidity discount, because the share has been not freely traded in the market, and you have to pay certain percentage to your advisor consult to arrange the transaction with the say buyer and seller. So based on those parameters, we have considered 5% as a liquidity discount. And another
No, but But that doesn't capture the time that it takes. You have only calculated the expense part of it. So you arrange a broker for 5%, but if it takes 2 years for you to liquidate,
Correct.
the expense of 5% is not a reflection of the illiquidity, right?
Correct. I agree with you, sir. So, that's why liquidity discount change from the scenario to scenario. In this case, why we have considered a 5%, because the company is already having a agreement with the advisors, where they are arranging the investor, and the discussion was at the advanced level, like it was in the term sheet level. So that's why we have considered the 5%. The discount can vary from 5% to 30% based on the certain parameters, which is considering the time horizon, considering the investor appetite, whether you will get an immediate cash flow or no. That is also important factor considering the discount.
Thank you.
Yeah. So that's it from my side. If you have any question, happy to address.
I still didn't understand. So are we telling that 13.4% is the median multiple, and we are reducing it by another 10%, so 1.34, and that is how we have arrived at the discounted multiple of 12.04. Is that what is the understanding?
Yes, absolutely, ma'am. So basically, what happens? So whatever median you're calculating based on the market information and based on the freely liquidity, right? So those companies are being freely traded, and there will be the size discount also. Those company maybe will be say larger company than their target. So we have to apply certain discount or a premium based on the considering our target audience, our target company, right? So we have applied 5% discount on the median whatever the market is giving. So tomorrow if I go into the market, right? So it will take some time, as sir mentioned, right? So it will require some time to go into market and encash my share liquidity, right? So those time value we consider as the liquidity discount. And again, the size discount, because the company size is very small, or compared to the peer company. So hence we have considered the size discount, because it will be difficult for the company to capture the market in the future because of the competition. So these are the few parameters we consider while doing the discount and adjustment.
So now that, as per CCM, we have arrived at a value which is 1,079 crores is what I'm assuming, or million, whatever that is. And value as per, comparable transactional method is 996 crores. Correct. Now, ultimately, we have to arrive at one value. So this is a range of values, right?
Correct.
So how did you conclude this?
So this was a transition, this was an assignment for the main for the, not for the regulatory compliances, but for the transition. But for the conclusion part, we try to understand which are these two companies, and we actually give a weight considering the availability of the data of these companies. We never average this value. So maybe we can give a weight to a particular company. Say if we have the more conservative approach on the market, and we understand the market information is correct, true and fair, so we give a higher weighted to the market approach, where comparable companies being considered very good way to value a company. So say in this scenario, we can give a 60% weightage to the CCM and a 40% weightage to the CTM.
Okay, one other question that I have is, see, in CCM you have given a size discount, whereas in CTM there is no size discount. What is the rationale behind that?
Acha, that is again an interesting discussion. So in CTM, while valuing a CTM company, right? So we do say our research in such a way, first we understand which are the transition, and then which transition have taken place with the lower kind of investment. Say a particular, while doing an investment, the investor had participated only say 5% of the equity, or and the investor has taken a size smaller company. So while doing a research itself, we eliminate this size consideration. Like in listed company you can't eliminate, because the listed company peers are very limited. But in transaction, if you can identify the say list of say 10 companies, right? So out of 10 companies, you can identify which company, what is the revenue size, whether the revenue size is comparable to your company or the company having a bigger valuation revenue cycle. So usually we consider the revenue cycle which are nearby our company. Am I able to clear this question?
Yes, thank you, Amit.
Yeah. So like while doing analysis now, so maybe just hold on. Yeah. So I don't have in this laptop. Maybe I can send across to the Shilpa ji for the separate, methods we use for the CTM approach, and I can, give a snapshot. How do we filter those criteria in CTM? Because CTM more kind of, data driven and the database driven. So that's why I just try to focus more on the comparable company, which, we easily, freely calculate. We can calculate based on the public information rather than relying on the databases. If anyone has any question, happy to address.
Hi Amit, if consolidated financials is there in the database, so how we can consider that one? So if suppose is a peer company, if I want to value the more investments is in subsidiaries is there. So I want to know from the market multiples based on the consolidated multiples rather than a standalone basis. So can we adjust, see, we can take the database from the screener and we will get the consolidated multiples. Okay, we can arrive based on the prescribed formula of market cap and arrive the EV by EBITDA or EV by revenue. So when we are doing, suppose in the market approach, CCM approach, whether this investment in subsidiary, it is if I'm doing a standalone basis in a DCF, so I can add separately this investment in subsidiary as a non-operating asset. So when I'm doing a market approach or a CCM, so I am using the consolidated basis, the multiples. So I can ignore this investment in subsidiary straight away, right?
No, sir. So sir, whenever you do valuation, right? So now the marketing valuing this company considering the investment value also, right? Hello.
Correct.
Yeah. So the market is also valuing this company using this investment value also. So now so we understand what is the first quantum of this investment value compared to our own value, right? If suppose my investment value is significant, then my comparable, say my investment value, we have arrived say 100 million. Vis-a-vis, I have my equity value arrived based on my calculation is say 200 million. So we try to eliminate those companies because it is very irrational to compare a conglomerate company with those kind of company. So we again identify additional company who is being traded and which has a very lesser investment part compared to the larger investment parts. So usually we ignore this kind of company where no investment is a high or subsidiary value is a high because the market might be giving a value to the subsidiary rather than giving the holding company.
Okay, understood. So in my case, it is the investment value is a little less, 5% of the total equity value. But however, when I am doing a CCM approach, I am taking it based on the consolidated multiples.
Correct.
So at that point of time, when my cash flows are the market has been looked from the consolidated basis. So then I am not adding separately this investment because already the cash flows is already included in the CCM.
Correct.
So while I'm doing a DCF, but I am adding separately because I have calculated a standalone basis. So is it make sense or not make sense? That's what was not so clear.
Yeah, it makes sense. Like what you mentioned, the market is valuing, the market price is captured their investment value. So I just need to understand the concept of investment value. It is say tolerated table, say 5 to 10%. So we can ignore that. And if it's beyond that, then we have to perform additional procedures. We need to understand whether how the company is performing based on its subsidiary level also.
Okay, got it. And also forward multiples. So what is the right practice of the looking the forward multiples, or is it the current multiples or TTM multiples? Is it make sense to take TTM multiples rather than the forward multiples, or what is the right practice?
Sir, usually, like majority of we do a current multiple, we consider the current as on date multiple because forward multiples are not available easily. And again, forward multiples are being arrived by the broker. So whenever the analyst issue a report, say now Crystal has issued an Infosys report. So they give us different forward multiples. So this multiple being captured in the various databases like S&P Capital IQ on a Bloomberg. So you have to understand the again. So there is the average of the multiple of the different broker. One broker is giving 12 multiple, and another is giving 15 multiples. So again, so it's a derivation method. So rather than avoid the subjectivity, we consider the current multiples only. But foreign multiple usually being accepted as a IPO kind of whenever we do a road show with the investors. So this foreign multiple usually considered as a benchmark for the market.
Okay, got it.
Yeah.
Amit,
Yeah.
can you hear me?
Yeah.
Well, actually, you shared in your initial talk that you will also cover other than listed company also. So you would like to throw some light on that. Till now only listed company discussion has happened.
See, for unlisted company, Shilpaji, what happens? A lot of information being captured by the database because it's not freely available. So what usually do for this kind of database, we first do a lot of Google research. Whenever we do a lot valuation for a particular company, we try to understand if there is any news in the market in this kind of segment, because unless and until you have a database, you can't. It's very difficult to identify which are the company being are under transition process for this segment. So one of the criteria, we use a lot of financial news platform like VCCH is one of the platform where we do a lot of research for a particular company to identify the transactions related information. And if you suppose identify certain information, now the another challenge, while calculating the information, like similar like we calculated the information for a comparable companies for transaction, you should have the database. So the databases will be available post the filing of the NCA, say a particular year. So it takes time to if you want to calculate the manually, and if you wanted to go offline rather than going to the databases. So it usually you will get the information of the last 1 year. You won't get any latest information. So that is a challenge. Usually every valuer face if he's not using the database. So hence the many people doesn't use the transaction approach, market approach, because of the lack of data. But multiple databases provide the information of this transaction. Maybe a group of people can subscribe to this database and can access this information. So like while accessing the information, how do you do a selection of the company? So there's the ideal way of the selection of company during the transition. First we consider the say same method like we have considered in the market approach, which is a industry selection. Once we select the industry, we highlight through a product and service. After product and service, now we consider the revenue criteria for the valuation purpose. Say a particular company, say there will be a certain company who are doing a transition, but they are very big. So those companies, it's very difficult to compare these companies with my peer company. So we also filter the criteria based on the percentage of stake taken during the transition, revenue of the company, EBITDA margin of the company. Those are the 4 or 5 parameters we use while identifying the transition multiple, like while analyzing the transition for the purpose of the CTM approach.
So can we say that if this research is is the fresher okay, if he doesn't follow the market approach and say it's not applicable because maybe comparable transaction he could not find, even if he gets comparable companies, how to find out the enterprise value in a small company?
No, sorry, I couldn't get your question. Sorry.
In case of a startup company,
Uh-huh.
okay, it may not be feasible to buy these costly softwares.
Correct.
Okay. And even in case, we do on our own research.
Correct.
Okay. Comparable transaction, if we get that, nothing like that.
Correct,
Okay,
absolutely. See what happens now for the startup company now. There are like in the news article, it's many times it is mentioned like how the company is being valued at what multiple, and there are certain research report also published. Maybe I can share one of the research report. Where this research report mention how the industry is operating in terms of the B2B and B2C market. Say now a SaaS tech company usually being valued at 8 to 10 multiple. So they throw some idea, how this company are being valued. So those research report also being used and useful for the making a decision making while using a CTM approach.
okay. A CTM to some extent fine, but comparable companies method. Okay, even I'm able to identify a comparable company. How do I know that company value? I'm talking about a startup private company. Now I'm able to identify peers. Okay, the other company, my company is also private company, other company is also private company. How will I know their valuation? Can I take pure net asset value method basis? That will be wrong, no?
No. See what happens now in that case. Now we check the filings of the NCME. It's try to see if there is change in the capital structure of a company. If he has capital structure, we try to understand at what valuation. Say if someone has invested has done a say primary funding, right? So in that case, we the information being captured in the reserves, security premium, the share price. So we try to calculate, at what time the investment has happened, and we do a reverse calculation to understand the valuation metrics. So we draw a financial data, say like last available financial year before the investment, and we see what will be the valuation pre-money valuation for a company and what will be the post-money valuation after the investment. So again, it is a very judgmental call, and it required a lot of efforts to calculate, but you never consider the net asset value method.
Correct. That was just a discussion or a perspective, and we have to see the timing also. So maybe, I am in my first round and the other comparable company is at a different level of funding. So I'll have to go back in time for that company.
Definitely the size matters, and they suppose that company is having already been a user, they have the market shares, market presence, user base, and there will be very easy for them to capture the market. So you have to see what will be the currently for those kind of company. You can see what will be the trend of those company, how the company is been valued at a say if the company has done earlier round of investment. So you can draw a financial and you can put and you can understand what are the multiple company being traded at the different levels. So you will get some idea how the company being valued throughout its journey.
Okay, thanks. But can we also write, we are not unable to use market approach? Is that phrase okay?
So you can always caveat that, you are unable to identify the right peer. Again, it's a value judgment whether to consider the peer company as the comparable company or no. Like you can always say, this company is being the market and the product of the companies are different. And the company is not directly comparable to us, and hence we have rejected. Many times we also ignore the market approach because of the non-availability of the data or because of non-comfort of the data. Whatever the data has been drawn from the system, and if we don't have the comfort, still we ignore that part. After the doing all the calculation, everything, and we are in a view that this method is maybe the valuation errors may not be the correct, so we ignore based on the certain parameters saying the management is maybe different, approaching for a different segment, different product, or the comparison are not in the right way.
Okay, just to extend my point. Okay, suppose say example, I got a foreign company, comparable company. Okay, so can I reject saying that, because it is a foreign company and there are no Indian company, I don't have a comparable company? Is that approach fine?
See, now that is again another level of discussion. For example, in a foreign company, again the for foreign company, like say for now, if you want to compare foreign company with the Indian IT company, so there will be not a right way to directly ignore that, right? So like say TCS and IT company majority business come from the foreign market, right? They have the significant portion of the exports. So actually the company driving his revenue and from the profitability from the foreign market also. So there is a two different school of thoughts where one say, we should look at the from the revenue metric, the company from where drawing the revenue, whether it's the foreign market and the local market. And another school of thoughts, the US market is very matured market, and the investment style of the US is very different, so you should ignore that market. So it's again a value or judgment. How do you want to take this as a challenge? Like you should justify in a both case.
Any chance of you, in any statutory authority, you had a chance to represent on this market approach, either IT authority or?
Yeah, so we did one classic valuation for a company where we couldn't find any comparable in India. So what we have done, we have considered comparable from the different geography, one from the European country, one from the North America. Why? Because that company was completely operating into the foreign market. So that company was doing the engineering work for the foreign clients. So they got a scrutiny from the transfer pricing department. So they had some certain kind of internal transition, and so they got a inquiry from the transfer pricing. So we done a valuation considering the foreign market, so North American, European market, and we justify the transfer pricing authority. This is how the company being valued in the market. So this is how we close that transition.
Okay.
I didn't understand. Could you please tell me what was the issue? So transfer pricing authority, what was the issue raised by them? What is the value that has been ascribed to these companies? Was that a question, or it was with respect to the transaction that was undertaken by the two different companies?
So what happened? There was an Indian company who were operating for the foreign clients, just exclusively for the foreign clients. So they said their certain share to a related party. Okay. But that transaction happened in the arm's length price, where now we have done the valuation and we have justified the value also. So transfer pricing authority has called the assessee and asking, what is the basis of this valuation? Say we that time we have used the comparable company method, and we have considered because of the non-availability of the Indian data. So in India there was only one company which was listed, but also that company was listed on the emerged platform, not on the main platform. So it was a SME company, so which was not directly comparable to the our client. So what we have done, we have considered the foreign companies, foreign client, because my client main revenue is driving from the US and the European market. So we have considered the European and the American companies for the comparison purpose.
Got it. So basically what you're telling is that the transaction was relating to transfer of equity shares of, between two related enterprise, and that was that the valuation of that transaction needed to be justified before the TP authority.
Correct. So assessing officer has asked, to justify this valuation, why you have considered this value. So this is how we have justified our valuation methodology, saying, you can consider the foreign market or comparable also, but you have the right justification, the revenue should be drawing from that market, or you have the significant influence of your company from the foreign market. Like tomorrow, suppose US collapse, the one of the impacted sector will be the IT sector. So that is
that.
Yeah.
Any other challenges that you have faced as a valuer similar to this, where you had to, now in this case, you provided a valuation report, or you provided a justification to the transfer pricing authority through the valuation report. So is there any other challenge that you have faced, where you had to kind of justify the valuation that you have undertaken?
See, for regulatory authorities, I have done this one only cases where, actually we have asked for the present to the department, but in a certain cases, I have done a lot of from the investor perspective. So what happened now, there was a company which already having an investor on the board. Okay. Now, because of certain SP and SHA agreement, so investor want to exit because certain clauses. Now investor was asking X amount of the valuation from the company, and company was defending on the Y amount of valuation. So while defending those valuation parameters from the client side, we actually calculated the CCM approach, CTM approach, and the DCF approach. So we have given the weightage to every approach, CCM, CTM, and DCF approach, saying why CCM is relevant in this case, why CTM is relevant in this case, and why not the DCF is relevant in this case. So like investor was valuing a company considering the foreign market. Now what was investor saying, I have invested considering my foreign portfolio, but how we justified saying, this company drives its revenue from India only, there doesn't have any presence in a foreign country, right? So how do you justify the premium of the pricing for my client without giving him the right valuation? Suppose if you operate from a foreign market, you have the always right to command a premium pricing over the local, right? So the investor in a view that I'm comparing from the global perspective, say in the global that company being valued 20 times or multiple, but we valued that company considering the Indian comparable, Indian transition at the 12 multiple. So there was a huge 40% deviation between the valuation of the investor and the valuation between the promoters. So in certain cases, the CCM approach very helpful for the value negotiation with the investors also.
Amit, I have one more point. Okay, since you are into buy side, sell side, and all of that, so what impact has this COVID has on the deals which are happening right now? And is it that the market is of the view that we are in a recovery stage post COVID, and the valuations are at a better priced rather than say 6 months earlier or 1 year earlier? What is your personal on the hand experience on the deals which are concluding right now?
See, Shilpaji, now in this phase now, so every segment has a different methodology to value now. IT segment and the pharma segment is getting a much better valuation than the earlier phases. Like, if you compare the valuation metrics of 2018 and 2019 for the pharma and for the IT company, it was very, very low compared to the current valuation metrics. So currently, what we have seen a lot of traction from the private equity and venture capital market for the tech-driven businesses. So right now we are running a deal for the few clients. The majority are clients based on the Web3, blockchain, and the AI-driven technology. So they are commanding a valuation of say 10 times of revenue multiple also. So like every segment has a different way of certain segments are being overvalued compared to the last high time overvalued in the current scenario, and some segment are again at a very decent level compared to the pre-COVID level. So say considering the apparel industry or entertainment industry or retail segment, not grocery retail segment, other retail segment are very nation level compared to the pre-COVID, but certain segments are being valued very decent at a decent and a high value post COVID also, based on the segment.
Okay, so one more few points for the benefit of everyone. So when you take this enterprise value and the multiple and all of that, and you discount it with respect to size or whatever brand or whatever it is to our thing, what are the complete the whole sum of adjustments which we have to make when we get the enterprise EV multiple, whatever we have received, whatever we have calculated till now, to adjust it to the present company, what we are valuing, what is the entire gamut of discounts and any benchmarks which you have in mind, how do we justify? Say, for example, you have taken some 5% size discount. How do I justify it? What is the parameters which I as a valuer can put and check whether it has to be 5%, 10%, 20%? Is it on plain revenue proportion or how, what is the best method? Can you guide us?
So again, over the period of time now, we internally have developed certain parameters and to avoid the subjectivity, because a lot of assignment comes. So you can't focus on every assignment whether you have to apply 5% or 10%. So there should be a scientific way. So there are certain formula given by certain professor. I don't recall the name, but I have their research paper. I can send it across those research paper. Those research paper are very helpful to determine the discount rate.
Correct.
how usually we take internally, we have categorized the different criteria. As I mentioned, the revenue size. So we classify whether the revenue size is comparable, high, medium, low, and based on those parameters, we have given a certain say pointers from which we take a weighted average combination, and we arrive at the discounting factor for the valuation purpose. So internally, we have developed a different calculation methodology for the calculation, but there are various research papers available which guide us on the scientific way of calculation for this discount and premium.
Can I tell something on about discounts and premiums?
Sure.
See, basically, there are studies like pre-IPO in US. In India, there are much in advanced markets like pre-IPO studies and restricted market studies like that. Pre-IPO studies basically no, takes the discount considering the what is the price that was the particular share script was sold before the IPO and after the IPO. What is the differential amounts? So that they considered as illiquidity discount, because pre-IPO there is no readily available market, and again there are restricted stock studies, so you place restrictions for transferability and all. So in such case, there are also studies about the restricted stock studies, and in that case also, what is the differential price between the stocks which do not have any restriction for the sale and all, and what is the sale price of those which are having the restrictions. So the differential can be considered as illiquidity discounts. And apart from that, you have, as he mentioned, there are certain models which the professors have published. One is Chafe model, and the other one is incremental Fernity model. All these models are like they take put options into their models. Basically, the stocks, when it is considered as restrictions are in place, it is considered as put option, so that the price, the restrictions are considered as put options, and you have to perform. It is a modified version of Black-Scholes option model, wherein you get the discount by using those models, so that you can apply those discounts also. And apart from that, in case of companies which are, if you are using trade like CTM multiples. CTM actually, as he mentioned, it is very difficult to apply because CTM has a lot of intricacies. If it is a merger and acquisition transaction, it is a strategic investment. The investors usually consider their own synergies. To differentiate those synergies, it is very difficult. You have to remove those synergies to apply it to your subject company. So CTM always consider the control premium, whereas CCM doesn't include the control premium, because the market price is available on marketable minority basis. There in CCM you can apply only D-long discount. If you are valuing the private company based on the CCM multiples, you can apply D-long, that is discount for lack of marketability. But control premiums and all are not, and you can also apply control premium if at all you are valuing the control stake in a private company. But whereas in CTM, it is always on the majority of the times on the control basis. There you need not apply control premium. But as he mentioned, that there may be a possibility to adjust for discount for lack of marketability. The second thing that, as I say, as I mentioned, the synergy part is very difficult to address. Financial synergies and operating synergies, all these things are very difficult to adjust. So that's what
thank you, sir, for your valuable input. So I'll just add on this, the point you mentioned about the illiquidity. Initially days we used to consider the same methodology, but by considering the current valuation, the market value current, like say if you consider the pre-IPO for the Paytm and you consider the listing price, so you can't justify the liquidity premium in the short span of say 15 days. The company has been corrected by the say 40%. So those challenges we recently faced during this valuation of this kind of company for illiquidity discount. So this is the
You
ideal.
need to take service, like you have to study the lot of, it is not one company, you have to take in a sample size more, population you have to study, and from there you have to pick up, and industry wise you have to take.
Correct, absolutely. So there is a risk also. What I'm trying to address, like sometimes IPO also, like the company being open at the IPO date at 100%. So you can't justify saying the liquidity discount is 100%. No. So those are the practical challenges we face. So yeah, definitely that is a good way of calculation for illiquidity discount as a large percent. But in the current scenario, it is very difficult to calculate from.
And one more aspect is that you have to study the parameters of the comparable companies, wherein if the companies, if you plot an Instagram or percentile calculations, those companies which are falling with, if your subject company is falling within the range of 35th percentile, in case of transfer pricing, you do the 35th percentile and 65th percentile, something like that. If your subject company is falling within the range of 35th percentile, whereas comparable companies are falling, some of the comparable companies are falling in 65th percentile range, the differential between those ranges, the capitalization rate you can calculate with an inverse of the PE multiples and EBITDA multiples. So that capitalization rate difference can also be taken as additional risk premium for your subject company. That can also be used to adjust your multiple. So that is one of the ways to adjust the multiple. We adjust the multiples based on that.
Correct. Absolutely agree with you. So the usually the industry consider 25 to 75 they eliminate those kind of quartile from the statics and calculate the average as you discussed. But again, it's a way of if you consider the if you compare with the median, ideally the range is a similar range. What we have seen in our past workings.
Is this correct for the illiquidity discount that we are talking? I typically consider two aspects. It takes typically a year for something from a illiquid to liquid happening, and the Nifty or the industry return that I'm going to get over 1 year, which is typically 15%. So if I expect a 1 year time lag for it to move from illiquid to liquid, 15%. So that is what I use as a discount for illiquidity discount. Is this a good way to look at it?
Sir, yeah, it is one of the way to look at it, but again, so you can't say justify 15% a return, because 15% return is a long-term return, say over a period of 10 years. Because in some year you will be getting a say 20% return, some year you will be getting a 10% return. So ideally, what we do, we consider sometime what is the risk-free rate for the client, and we add on for certain percentage for if we play certain play with the treasury department, if we can generate a delta. So based on those parameters also we play sometime. But of considering the blindly 15% of 1 year.
No, I meant short-term 1 year return.
Yeah, short-term 1 year is a better
risk. Yeah, because that's a diversified, similar kind of a risky profile return. So what I get is typically that could be the basis. So if the expectation is that it would take 1 to 2 years, then accordingly I adjust the return value. So principally that is the basis of determining the illiquidity discount in a most simpler version with some justification.
Correct. Yeah, ideally it's a good way to calculate. But again, sir, if you consider for the 2 years, again, we have to justify. Like the justification should be required, but yeah, this is one of the good way to calculate. Say there's a loss of money and the time value of money involved. So there's ideally you can consider those kind of parameters also.
Can we conclude the session? Now, anyone else has any point?
Mr. Amit, I have a question. See, is that the market approach can be used for the company which is under liquidation for determining the realizable value under Regulation 35?
Sir, one of the valuation, the basic assumption is the company entity should be a going concern.
Oh, so market approach cannot be used for liquidation, company under liquidation?
Ideally, we should not use, because the going concern assumption is, so one of the assumption is you will, so why what do you understand by the multiple? Multiple is nothing but you get a payback of your EBITDA in that period of time, right? So if the company is not going concern and company going to liquidate, so there is no way to use a market approach for those kind of companies.
So you mean to say when there is no revenue multiple, EBITDA multiple, PE multiple, then market approach cannot be followed?
Ideally, we should not follow because the going concern assumption is not there unless and until there is any strong justification. Like 99%, we should not use the market approach.
So, I agree. Suppose there is a lot of offers to take over the company, can't it trigger that there is a value in the market for the company? Suppose the company is getting a lot of offer as a going concern. I am not saying company which is dissolved. I am not saying today the concept of going concern is getting evolved in the liquidation, and the courts also giving in orders that during liquidation company should be sold as a going concern. In which case it is sold as a going concern, though they may not be comparable revenue multiple or EBITDA or PE, but the orders are now coming up that company should be sold on going concern. Then the RVs are now under obligation to value it. In that case, what should be the way out?
Ideally, what I've seen, whenever the company is going with the liquidation, so there is a lot of issue with the reporting part. Here the EBITDA will not be correct EBITDA reflection. So right now, suppose your valuation is depend upon the EBITDA multiple. Your EBITDA is not a correct EBITDA. Then how do you justify the market value is a correct market value? So another example is extra, like which we point discuss about a debt and debt like item. So there's a clear risk of the companies may be delaying the payment or company doesn't have the recovery, right? So those parameters are being very difficult to address in a market approach. The basic assumption of market approach, to understand that the company should be say 90% company is clean and the EBITDA is a correct EBITDA. So there's not any improvement because you are ultimately valuing company based on the EBITDA multiple or a certain price earning multiple. If the company's reflection is not correct itself, so the valuation may be completely of the number.
I understand. I just put the same question in a different manner. The company now, which is undergoing, which is in liquidation, where it has to be sold as a going concern, and the court orders for valuation. So now point is that the plant and machinery evaluate will do it in a cost method. Land and building will do it in a cost method. Then which method the SFA value should do for the understanding realization to ascertain the going concern value? I'm not though company under liquidation, but to ascertain the going concern value, it permits the court permits to.
If you want to use a market approach, then you need to identify the adjustments. Like as I mentioned about the excess management remuneration or rent, right? So you need to identify what is the sustainable EBITDA for the company. So because current EBITDA may not be the sustainable EBITDA. Suppose tomorrow, if you want to run the show of that company, you might be incur certain costs for the professional management, or you have to restructure your team, right? So there will be the additional cost. So then you should capture those parameters in while valuing the company, and you do a adjusted EBITDA calculation, and which should be justifiable. Then definitely you can use a market approach. Because what I'm trying to say, if you have the clear picture on the say adjusted EBITDA, then definitely you can use. If you don't have the clear visibility on the EBITDA earnings, then you should not use, because ultimately multiple is depend upon the EBITDA.
So okay, the point as I clearly understand, company which is under liquidation, understand market approach is not possible. But when it is so to be sold as a going concern, then the market approach can be applicable to some extent.
Then you can identify certain costs which needs to be reflected, or certain cost advantage company can improve. So you can provide this is my basic say book EBITDA, reported EBITDA, and this is a certain calculation, adjusted EBITDA is this, and based on this parameter and assumption we have arrived the market valuation.
Okay. Can we give any information in the market, some weightage in the valuation by SFA, in some information in the market, good information or some potential business to the company? Can we give some weightage to this while valuation?
You can't give a prospect about the futures, right? Like say a prospect, company will be doing a good business or something like, because it's a very subjective matter. right? What I'm trying to address, you should capture the cost and relevant metrics to company to arrive to sustainable EBITDA. So I'll just give you a quick example. Like we do a lot of financial and accounting diligence. So investors always try to understand, so investors come to us and try to understand the company has reflected this financial and company has reflected say 5 million EBITDA, right? So investor asks whether this 5 million EBITDA is sustainable or no. So what we do, we understand the revenue recognition policy, whether company has recognized revenue properly or no, whether there adjustment is required. So whether cutoff has been performed properly or no. So and again, so whether company has captured all the provision, whether company has recorded all the cost, whether there is additional investor has to bring professional management to run the show. So those are the adjustment we need to perform to understand the sustainable EBITDA. You can't comment about the future of the company. Company will be doing in the future, which is not your right way to value a company.
Okay, thanks a lot, Mr. Amit. Thanks a lot.
Can I say something here?
Yeah, sure. Thank you.
In case of liquidation, it's really challenging to go for this going concern value. But in case of CRP also, it's really challenging because there are not much difference from the CRP level to the liquidation level as far as the operations are concerned. Very rare companies which have got the potentially viable options. Otherwise, normally the CRP, since economic failure is there, so it is very difficult to use the market competitively approach in case of CRP also. So in there also normally one aberration is further there, that in case of CRP, the valuers are appointed in silos. So if the valuers are appointed in silos, then the financial valuer, this SFA valuer, doesn't have the detail also of the entire thing of the company. So that is also there in CRP also. It's very difficult to do the going concern valuation in the CRP also. This is my view.
Correct, absolutely, sir. That is why we avoid to use a market approach, because that financial doesn't reflect a true picture of the entity. Everything is cooked up. That's why the company maintains the liquidation, right? So the basic assumption of the using a market approach is like your EBITDA is sustainable EBITDA. That's why you are using a multiple and you are saying that this EBITDA will be recovered over the 8 years. So what is the basic assumption of the method, complaint method? So, but if the valuer is identifying a good way to understand the adjusted EBITDA, then yeah, maybe he can justify the value. But again, so availability of the information is a big challenge.
That is it.
I have a question with reference to the minority interest held by the companies.
Yes.
In certain companies, if you take Paytm itself, they invest in other companies, right?
Correct.
So it's not subsidiaries, maybe associates or kind of a minority interest, maybe 10%, 20%, 30% kind of a thing.
Correct.
In such a scenario, you don't have access to the projections of that company. That way, in a way, you can't perform the DCF model.
Correct.
And book value is not justifiable. Maybe some of the companies' book value is negative as such.
Correct.
So can we apply market multiples for valuing those investments? If so, which multiple is the better multiple?
See, sir, now this is one of the interesting topic. So I'll just give you a classic example of Naukri.com. You keep aside the Paytm, consider the Naukri.com. So Naukri.com is a new tech company earlier, which was holding say 18% of the Zomato. And they have a lot of other portfolio companies which are then like Policy Bazaar and other companies. So in this case, now what we do, we first understand at what time of valuation the company has valued the company. Say Naukri.com has recently done a valuation of the Zomato, right? So they have invested recently in a transition. So so the market is already capturing those parameters. So we try to reduce and we try to calculate the normalized what will be the multiple for this kind of company. So I'll just give an example. Now we have calculated the say market capitalization of a company. After market capitalization, we adjust the whatever the investment value a company has made to in the Zomato or other subsidiaries or other associate companies. and we try to understand if company, if the from the market valuation, if those parameters are less, at what value the company is being traded with individual level and with the all subsidiaries. So it's very difficult. You cannot justify whether the market is giving the valuation actually for the Zomato or actually for the Naukri.com.
My question is that if the subject company, if it is a private company, I'm valuing that. If that private company in turn is holding investments in some other private companies, so minority interest. So in such case, how do you value those investments? Because lack of information on the financials, projections and all, and the book value is not correct. And
Understood your point. So is the investment is the latest investment or the historical investment? Because you first need to understand whether, see, if say you have invested money in last 1 or 2 years, so you could have invested at the fair value only.
Okay, if it is invested long back.
So long term back, you need to understand the first thing, you need to understand first the financial of that company, and from the financial, if the very significant portion, like the the valuation of the companies, like the numbers are very significant, then you can quickly use the market approach to see what is the range of that company. You may not be calculate the actual value, but you can use a market approach for the investment. So usually what happens, like you have the investment, right? So you see if there is a significant portion of that company's balance sheet size or the income size is a very good size, say 100 crore company, and you are holding 2-3% in that company. So you consider them multiple way and you try to identify what is the ideal way of the range of that company. You may not be give a correct picture of the investment, but at least you can highlight this, this is a surplus investment and the basis of the investment is the correct this calculation.
Thank you.
Friends, we shall conclude the session now. I request Mr. Gangadhar to convey a vote of thanks for today's speaker, please.
Thank you, Amit. Very good insights about the market approach and screening of the comparable companies and databases. Enlightening about the free databases and applying the multiples, discounts and premiums and the adjustments to the multiples. It is really a wonderful and enlightening session. Thank you very much.
Thank you so much. It was an indeed learning session for me also. Everyone is evolving. We are learning day by day new things. So it was a great session for me also.
Thank you very much, Amit. It was a very useful session on a Christmas morning.
Thank you so much.
Thank you, Amit. Thank you.
Wonderful audience. So the conversation always are helpful, to understand, to learn from each other, because everyone is now facing a separate challenge in a day-to-day operation.
Correct. Very happy Merry Christmas and Happy New Year in advance to all the BVA members and today's participants. Thanks all.
Thank you so much.
Thank you.